Hey, welcome back, man. It's your guy Jesus Hawthorne. Some of y'all know me by Mr. MUB. Like to welcome you, man. Like to welcome you. So, right now, last video I got through showing you how to set up your cash flow manager, and like I said, that's extremely important, man. That's the IRS audit-proof software system that you're going to need. It's the backbone to your business in regarding of tax minimization. So remember, you definitely want to make sure you got the right justification and the documentation to write off those things that will equate your lifestyle. So now we want to go ahead and set up our cash flow strategist, and that's what we like to call our financial GPS. It's our financial GPS. It let us know exactly where we at, and exactly what we need to go to reach our personal financial success. So, first thing you want to do, you want to go ahead and log into your MyEcon website, and you're going to be right here at the Business Management Center. From the Business Management Center, you want to go ahead and click on your income shifting membership. Remember, a lot of these things are already inside your membership. You do not have to purchase additional income. Use additional income to purchase this software. Is already available for you. Now, you want to go ahead and click on the cash flow manager. All right. So from the cash flow manager, you're going to see a tab at the top that says the cash flow strategist. So you want to go ahead and select that. Now, for those who have never sat in front of a financial advisor, that's exactly what this software is. It's the exact type of software most financial advisors use to create the plan to reach your financial goals. Now, most financial advisors charge you anywhere between $100 to $500 an hour, depending on your circumstance, right? But guess what? You can actually do what they do for yourself. That's what's so powerful about using this software. Another thing is, if you have family members, you actually can use this software to create multiple tabs, create multiple plans for even family members. So what I'm about to do is I'm about to break down exactly how to use the software appropriately, right? So you are going to select new. All right. Then you're going to name it. You can name it whatever you want to name it, and then there's going to be some questions that you must answer, and then we're going to tally it up. So instead of creating a whole new one, what I'm going to do right now is I'm going to back up out of this, and I'm going to select one that I've already pre-set up. So you see one that says MUB training. A lot of the team from the Make You Better family, we all got together and we filled this out together. So we're going to go ahead and select 8. All right, so you see at the top, it says MUB training. Now, it says your top 5 financial goals. You're going to put them in chronological order, from 1 being the greatest and 5 being the least. We select paying off all debts, reducing our taxes, increasing our income, saving for college, and then number 5, we said build retirement assets. All right, now you're going to put them in order according to you and your plan. So if you're married, this is something that you definitely want to sit down with your spouse and y'all fill this out together, because y'all going to need to work together as a team to hit these goals. But if you're single, you're going to fill them out according to what's important to you. All right, then you're going to scroll down to retirement freedom goal. The first question that has up there is, what's the least amount of monthly income do you desire at retirement? I like to tell people, let's go ahead to question number 2, and let's fill that one out. Then you can understand what number you might want to put at the top. So in this one, we say we plan to retire in the year 2039. So it's 2020 now. That's roughly 19 years from now. Now, one thing that we took in consideration, we understood that cost of living and inflation doubles every 20 years. So if we was living off of $5,000 a month in 2019, now you're going to put whatever number that you in, but I just need you to understand the philosophy. You would need to double that amount for you to stay permanently retired by the year 2039. So if you're living off of $5,000 now, you need to start putting a plan together for you to be bringing in at least $10,000 monthly by the year 2039. All right. So you're going to answer the rest of these questions right here. You know, how much money from your retirement do you expect to receive from Social Security and a company paid pension? They stayed by $3,000 right here. They asked what's their approximate value of your investment portfolio. We put $50,000 here. Now understand, you're going to put your information right here, and you need to make sure that it's accurate. So I highly recommend for you to go in and grab all your financial documents and information, because just like a GPS, you want to make sure this thing is accurate as possible. We need to know exactly where you at. So number 5 asks, how much money do you currently invest monthly in long-term savings? They said 475. Now, since you understand that you're trying to create a plan that's going to make you go to this destination, now we asking, okay, how much additional money monthly can you invest into your long-term savings? Because 475, you probably got that on autopilot, right? The direct deposit instead of moving off to the side. But now, since you understand, like, hey man, I'm really trying to retire, how much more income could you put towards that? They say, well, I could put an additional 250. All right, great. Now we're saying, how much money do you have set aside for the emergencies? Now, one thing I've learned in my econ, and I didn't learn this from anywhere else, is that you need to have 2 different emergency funds. You need to have a short term and a long term. A short term is roughly about like $3,000. A long term, what you see that's set up right here in those brackets, at least 6 months of living expenses. So you're going to put in all your living expenses information, and whatever that dollar amount is monthly, you're going to times it by 6, and you need to try and attempt to build an emergency fund that's going to equate this whatever that number is, equate to whatever that number is. So those are your 2 emergency funds. So those is extremely important. Extremely important. All right. Debt elimination. Now, for debt elimination, the first thing we need to do is understand the definition of a debt. A debt is anything that could be paid off. Anything that could be paid off. All right. So we put in some great examples of what we like to call debts, and you're going to put in all of your debts, all of them. So that's why you want to grab all your bank statements, all your financial information. You do not want to go off the top of your head or what you think is in your heart. You want to make sure this is accurate as possible. So let's say we had our student loans by $50,000, paying by $250 a month. Had car loans, $12,000 balance, paying $150 a month. We had medical bills, $5,000. We had a mortgage, $150,000 of furniture, about $12,000 in a credit card, roughly about $1,300 on credit cards. But you want to put in all your debts, and notice you got the little button right here, add debt. And you can put unlimited debts if you got a lot of them. You got more than these, then put them all on there. Put them all on there. Now, recurring monthly expenses. Now, this is something that cannot be paid off, but you are paying on them monthly. You're paying on them monthly. So we got put in some great examples: cell phone, electrical bill, cable bill, car insurance, food, internet, gas for your car, daycare, and even entertainment. Now, notice you got 2 tabs right here. You got current monthly costs, and you got a new monthly cost, right? So you're going to put in exactly what are you paying right now? How much money are you paying in right now? Now, since you got all your bills in front of your face now, because you'd be surprised, especially when you got most people got their bills set up on automatic draft, direct deposit and stuff right now. So a lot of times we don't even pay attention to these things, how much money we're spending on certain things. This right here is going to bring all of that to your face. So now you can make what we like to call an educated decision. Now with your cell phone bill, new monthly cost, if there's a way that you actually can minimize your cell phone bill, would you? And, my recommendation is for you to put, yes, like if you can minimize your bills, get it done. Definitely get it done. Now, then what you will put right here is your new monthly cost. And you would do that for all of your bills. So as you start going through here, looking at your bills, especially with something like entertainment, if you notice that you're paying like over $400 a month on something that falls in the line of entertainment, whether it's like going out to eat, clothes, wherever the case, whatever you do for entertainment, instead of paying $400 a month, just imagine if you reduced it to $200. So now you got a $200 a month worth of cash flow that you actually can redirect towards either investments or paying off your debt sooner, So you want to definitely put all the information on there, and that's what this new monthly cost tab is, because now you can make the appropriate adjustments, and then it will have the monthly savings. and then you're going to be redirect that money. All right, save, return to tab. So now I believe we are on B. All right, now at the top, you're going to see the rate of return used in this monthly summary. You got an 8%. Now, over here at My Econ, we highly recommend for all associates to find them investments that's going to give them at least 8% rate of return monthly. And the main reason why is because due to inflation and the cost of living, that's averaging by 5% annually. So if you got an investment that's not bringing you back at least 5%, you actually could be losing money, or if not, just maintaining, and your investment's not growing. And that's what you really want. You want an income producing asset which is actually producing income. So you need to start finding something that's going to give you at least 8%. And that's being real modest. You actually can find percentages that's way higher than that. So this right here is going to spit out the plan that we actually going to put in place. It's going to make it more visual. So you said our retirement freedom year is the year 2039. We expect to have about $10,000 a month coming in monthly. Our projected dollar amount will be provided by pension and Social Security, say roughly about $3,000. So right now we're short $7,000. So our total asset needed to provide desired monthly income goal at an 8% rate of return is roughly about $1 million. Most people don't even realize that. For you to stay permanently retired, you're probably going to need a portfolio of at least $1 million. Now that's the main reason why you see a lot of baby boomers who probably retired in the late 80s, mid 80s, late 80s, and now you're starting to see them come back to work. It's not like that they didn't work hard. It's not that they didn't attempt to put a plan in place. One of the main issues is that they didn't calculate the cost of living and inflation to impact them the way that it did. So now they feel like they're at the point that they're outliving their money, and nobody want to be in that predicament. So you got to plan for these things. So that $50,000 that they had in an investment account, by the year 2039, they had an 8% rate of return. It's going to mature to $227,000, right? But guess what? We still short $822,000 of our goal. So the way for us to hit this goal right here is we need to be investing at least $1,500 a month. Keyword, $1,500 a month, not a one-time payment of $1,500. We need to put ourselves in a position to do that monthly. Currently, we're only investing $475 dollars. So we still short by $1,000. So here's the question I like to sit down and I ask associates, and it's like a real serious question. Could you see yourself cutting back $1,000 off of your lifestyle to make sure that you permanently retire? Believe it or not, most people say they're not. So where does this $1,000 need to come from? Now, the reduction, that would be something that Dave Ramsey would teach, which if you are willing to execute it, it will work. I just know that most people aren't willing to do it. But the facts are proven. If you are willing, you can't get it done. You can't get it done. But one thing that I do know, most people will be more comfortable with making an additional $1,000 for them to hit their goal. Now that right there will be something that catch their attention. And that's why My Econ is so powerful, because not only are we going to help you eliminate debt, but we're also going to help you make some business income. So let's say somebody just now getting started in business and they was able to bring in like an additional $500 a month in business. Now, with the tax withholding, you remember that W-4 form, and we're being real modest right now. They was able to bring back an additional $250 back into the household. Now, most people, once they change that W-4 form, it brings back anywhere between $200 to $800 a month. I even seen some as high as $1,000, but we're gonna be real modest right now and use $250. So you also remember earlier in the plan on step A, we said that we had like an additional $250 that we could put towards investing of cash flow. So what we did is we took the tax withholding money and we took this additional $250, and now we created $500 that we're going to use in regarding of debt elimination. So remember all of those debts that we listed, and we had the balances that we listed along with the current payments. We're going to do that Dave Ramsey technique where we're talking about we're going to snowball debt. We're going to snowball debt. So we're going to take this $500. We're going to add it to the current payment. And then of that $1,300 balance of the credit cards in 3 months, we have eliminated $600. Now we're going to take that $6, we're going to add it to the 2 of the medical bills. So now we're paying $800 a month. So in 7 months, $5,000 worth of debt is going to be eliminated. Now we're going to take this 8. We're going to add it to the $350 for the furniture bill. So instead of paying $350, we're paying $1,150. In 11 months, $12,000 would be eliminated. We're going to take that $1,150 worth of cash flow, $1,150 a month worth of cash flow. We're now going to add it towards the car loan. Instead of paying $150 a month, we're now paying $1,300 a month for 10 months. $12,000 of that car note is going to be gone. Now we got a positive cash flow of $1,300. We're going to take that $1,300. We're going to add it to our mortgage. That's $930. So instead of paying $930, we're going to pay $2,230 for 68 months. In 68 months, $150,000 worth of debt would be eliminated. We now have $2,230 a month of available cash flow. We're going to take that $2,230 and we're going to add it to the student loans. Instead of paying $250, we are now paying $2,480 for 21 months. And after 21 months, that'd be $50,000 worth of debt gone, and now we have a net positive cash flow of $2,480, right? So what have we done? We have eliminated over $230,300 worth of debt in 120 months. That's right. By the year 2030, in 10 years, we'll be 100% debt free. With available net cash flow of $2,480. So now we can take that $2,480 and move it towards our investments. So this right here is a calculator that shows you exactly where we at. So we had our existing portfolio. You know, we had roughly about $50,000. We was already investing at least $475 monthly. So we added up those two, had $50,475, and now we got the debt eliminated, right? So we have eliminated all our debt by the year 2030. And now this right here is going to calculate the compounding effects of once we have eliminated the debt and moving towards our investments, right? So just like a financial advisor, it's gonna break all this information down to let you know, what does it take for you to hit your goal. Now, what's so special about this plan is if you hit it on time, like we did, hey, okay, this is an excellent plan, and if properly executed, if we execute this plan, we'll reach our personal financial success goal, freedom goal, by the year 2039, which is the year that we wanted. But guess what? There's been multiple times where people did not reach it according to its year. There's been times where the plan say, no, by the year, according to this plan, you're not going to reach your goal until the year 2044. If that be the case, you can always go back in and make the appropriate adjustments. You can make the appropriate adjustments, whether you might need to eliminate your debt faster. You may need to create more business income. You might need to start eliminating your expenses. Now you have time to make the adjustments to the plan versus, working an additional 10, 15 years and learning at the end state that, you're not going to make it according to the time that you wanted to retire. You can take action now, whether it's eliminating debt faster, minimizing more expenses, or creating bigger business income. That's why I love the software. I highly recommend for everybody to take the time and fill out your cash flow strategist. I'm gonna leave my contact information. If let's say you might have any questions, comments, or concern regarding of how to set up your cash flow strategist, as My Econ Associates, man, this is your financial GPS. Because if you plug in the information and you stay on that blue line, just like you're doing the GPS, it's going to take you to your destination. And this right here, this software right here is going to take you to your permanent retirement. Yeah, we're gonna help you get there. We're gonna help you get there. So that's this video. I hope you enjoyed it. You know, give me some likes, give me some shares if you know that somebody else could actually use this training. Y'all have a good one.